Confidence in Europe and Germany in particular is at a very low point. The economy is not doing well, and in particular, if you look ahead into the future, the risks are enormous. The ECB needs to do more to at least not slow down the economy any longer.
The euro has hit a two-year low against the U.S. dollar on the back of more economic bad news. In this case, a new reading from a purchasing managers index showing that business activity across the bloc contracted once again in November. Marcel Fratscher from the German Institute for Economic Research, or DIW, joins me now for more from Berlin. Marcel, how should we look at this new figure?
Well, confidence in Europe and Germany in particular is at a very low point. The economy is not doing well, and in particular, if you look ahead into the future, the risks are enormous. Donald Trump has threatened a trade war with China and also with Europe. The conflict in the Ukraine and the Middle East could escalate, so energy costs could increase again. So uncertainty is high, sentiment is at an all-time low. That means low investment, low consumption, and a very hard time for the economy to recover.
We know that the European Central Bank has already begun its shift from trying to curb high inflation to encourage growth. Should it move more aggressively when it comes to cutting interest rates?
In my view, yes. In my view, the ECB is a little behind the curve. It should have started ease more sooner. So beginning of the year, it should have started rather than in the summer. Inflation is back at 2% at the objective of the European Central Bank. And we must keep in mind interest rates in the euro area are very restrictive at the moment. The neutral rate, where the interest rate by monetary policy is not slowing down the economy, are substantially lower. So the ECB needs to do more to at least not slow down the economy any longer. And so, yes, I think the ECB needs to do more in the coming months. But mind you, trade conflicts with the US might mean at least temporarily higher inflation.
Considering Trump's election, considering these new figures that we've just seen today, can we definitively say that the European Central Bank will cut 50 basis points in December?
No, of course not. We shouldn't second guess the ECB. My hunch is that the ECB will be cautious and might just do another 25 basis point step. The dilemma for the ECB is, as I just described, that on the one hand, the economy is very weak, monetary policy is too restrictive. On the other hand, an increasing trade conflict, possibly higher energy costs, could again flame inflation next year. So my hunch is the ECB will be cautious in cutting rates and try to leave all doors open in either direction if the economy requires.
Why haven't the rate cuts to this point seen more economic activity, boosted economic activity, and encouraged people not to save as much, but to actually spend a little bit more?
Well, we must not forget monetary policy takes time to take its full effect. We estimate about a year and a half or 2 years it takes for the full pass-through from changes in policy rates to consumers and investment of companies. And so obviously the ECB having started cutting in the summer means we will see most of the effect only next year and the year after. And on the other hand, I also described the uncertainty. We have very high uncertainty. That means despite real wage growth in most euro area countries, so wages are rising more quickly than prices, many consumers are very cautious. They are insecure, and that means they'd rather increase savings than spending.
Do you believe the specter of inflation, the worst of inflation, is mostly past us right now, or is it still a danger for next year?
Inflation will always be a danger, but mind you, also deflation is always a risk, and the central bank always has to balance the two. Prices or inflation falling too far, prices starting falling. We have seen how difficult it can be to get out of a deflationary spiral in the case of Japan, which has been in that environment for 25 years. And the future will look very different from the past. We have seen that with the pandemic now, with the oil price shock, the energy price shock through the Ukraine war. Inflation is increasingly driven by global factors outside of the domestic economy, and that means outside of the realm of influence of a central bank. The central bank can do very little against the global shock, like an energy price shock, and therefore we have to be prepared to see a lot more volatility in inflation and prices in the future.
Or perhaps economies that are also getting older, countries that are aging faster.
Well, demographics does not necessarily mean higher inflation, right? Demographics means, first of all, if you have a shrinking population, it means you have lower potential growth. You have lower demand or lower demand growth, I should say, and that actually might reduce inflation. On the other hand, it means you have a labor shortage. My expectation, and that of many economists, is that we might see a big push on wages over the next 10 years, upward push, that could contribute to inflation. So it's not necessarily clear that the demographic change necessarily leads to lower inflation, but central banks need to be prepared either way.
You just talked about the EC's role in maintaining price stability, that is warding off inflation, but also deflation. You've written that the ECB should take on an inflation goal of 4% instead of 2%, which is its goal, as well as the Fed, the Federal Reserve's in the U.S. Why is that? Why should it target a higher inflation rate, which would then also perhaps be a little bit more disturbing for households?
First of all, we must be very clear that 4% inflation is not necessarily any worse than 2% inflation. It's all about expectations, whether companies and households know that this is the rate at which prices will rise on average. And if you look at the most successful central banks over the last 70 years, like Deutsche Bundesbank in Germany, they have had, for most of their time, inflation rates around 3 to 4% over the decades, and being very successful in stabilizing the economy and supporting economic growth. A higher inflation objective gives central banks more room to cut rates if there's a big shock to the economy. And one lesson of the last 15 years is that we really don't want central bank to get into non-standard monetary policy, like purchasing government or corporate bonds, because this has big side effects and can have big distortions in capital markets. So a higher inflation objective means central banks have more room to use standard monetary policy in case of a shock. It gives central banks also more credibility if they don't focus very narrowly on that objective, but that they admit, look, global shocks means inflation is volatile, might move around. But by and large, I think a higher inflation objective coupled with more discretion allows central banks to do a better job in achieving their price stability mandate.
Higher inflation also makes it more palatable to borrow larger amounts of money. We know that you're in favor of seeing more government borrowing in Germany, at least. Is that an advantage of a 4% target as well?
No. A higher inflation objective does not necessarily mean more room for governments to borrow. That might be in the transition phase, but if investors of government bonds expect there will be on average a 4% inflation rate, they of course will adjust their lending and borrowing behavior and the conditions at which they lend and borrow. So in the long run, the higher inflation objective should not have any real bearing on the financing conditions for governments.
Is that a politically hard sell, though, asking you to put on your political hat when it comes to households that have just gone through a lot of inflation? They've seen wages only belatedly rise to match it, saying that we're going to target higher inflation in the midterm instead of sort of a more manageable level of inflation, as many would see maybe 2%?
Well, again, sure. When households see higher prices, no one likes higher prices. Everyone wants prices to fall. But obviously, if you have falling prices, that might be good for consumers, but it will be very bad for companies for a number of reasons, because wages cannot be cut because of debt servicing costs and so on. So it's all about households being prepared and having a high degree of certainty. So the problem is not 2% or 4% inflation. If as long as your wages are rising 6, 7, 8%, you're fine with 4% inflation in most cases. The problem for households is really the volatility in prices. If you have years with 10% inflation, as we had in the past 2, 3 years in one occasion, and then years with very low inflation. And that makes it very hard for companies and also households to adjust. So it's really about stability of the price movement rather than the level.
There's a banking conference today in Frankfurt. Christine Lagarde, head of the ECB, is there today as well, the heads of other major European banks. And Lagarde began by saying that there needs to be a more cohesive capital union in the EU. This has been on the top of the wish list for many people in the EU, many officials saying it needs to be easier for people to be able to invest across the borders of specific EU member nations to free up more money for investment, especially at a time of low growth. Is that true, and is that something that's feasible? How important is a better capital union at a time like this right now when the EU is struggling so much?
Look, we have a common currency, the euro, and by every measure, it is a big success story for everyone. It has lowered financing costs for all European countries. Also, Germany is a big beneficiary of it because it helps its trade, its exports. But the euro cannot function properly and cannot unfold its benefits if you don't have a properly integrated capital market and market for banks and financial institutions in the euro area. Concretely, a capital market union in Europe would mean lower borrowing costs for companies and for households. It would allow for more investment, more consumption, more economic growth, more prosperity, more competitiveness. In particular, some of the smaller countries would benefit more because there the financing costs would decline even more strongly. So we need that integration in order to improve efficiency, lower cost, and improve financing conditions.
Do you expect after Trump's election to see some of these priorities really return to the forefront of the EU, giving up more sovereignty in a sense, or sort of overcoming former opposition to some of these policies, giving the ECB a bit more room to maneuver in terms of dictating price stability if, for example, it took on a higher inflation rate or inflation goal, or for a capital markets union? Do you think that these changes will be spurred now a bit more by the election of Trump?
The sad news is that over the last 10 years, we haven't made much progress in Europe on integration in terms of services, in terms of industrial policy, in terms of energy policy, in terms of capital markets and banking union. And the sad truth is that such progress is possible only when there's a crisis, when Europe is struggling, as it has been with in the early 2010s with the European financial crisis and after the global financial crisis. And the conflict with Donald Trump on trade, on other aspects, might force Europe to understand that national policies, nationalism, will not succeed in protecting European interests or any national interest in Europe. So we are much stronger in Europe if we speak with one voice. This also, and in particular, includes Germany, which is a lot more dependent on trade and trade with the US than most other European economies. And we need to understand Europe is the best protection for our interests, our economic interests, in particular in a world that is dominated by an increasingly protectionist United States and also China.
And that was Marcel Fratscher, head of the German Institute for Economic Research, or DIW. He joined us from Berlin. Thank you, Marcel.
My pleasure.